Alrighty, folks, in video number 1 today with Anna Kelly, we talked about a rolling recession. But now we got to talk about something that's near and dear to her heart and something she brought up first on this channel, and that is the dreaded stagflation. I'm starting to see more and more articles talk about the fact that we are either in or headed to, at worst or at best, mini stagflation. I don't know why we're splitting hairs here, but folks, stagflation is a real possibility. And Anna Kelly brought it to us first. Anna, how you doing?
I'm doing great. What interesting times to live through, right? We're getting to see all the economic theories play out in real time
In
and
real time, yeah.
a little bit of this and a little bit of that, right? The first video we talked about the rolling recession, and that was what you called first. And then I talked about, my concerns about it heading into inflation, inflationary recession, which is basically stagflation, where the economy is just stagnating. It's not really growing. It's not really weakening substantially compared to the growth, but you've got an uptick in prices or inflation at the same time that you have slowing, weakening growth. And the thing that I don't like about stagflation is it's really difficult for central banks to get you out of. And it's really difficult for economic policy passed by, the administration, the president and Congress to get you out of either without, substantial spending in different parts of the economy. And the tools that the Fed has to fight stagflation are opposite. So to get you out of recession, you need lots of money printing. You need quantitative easing. You need low interest rates to stimulate people that are at the bottom of an economy to start spending again, to spark that economic boom that gets you into recovery and expansion. But on the other hand, if you have inflation, you see what the Fed has been doing. They raise interest rates. They try to get you to stop spending. They try to slow down the economy because it's overheated. And so we've lived the last couple years, after COVID, we had the deep recession. What did they do? QE, low interest rates, money printing.
Yeah.
Got us out of it really quickly, but you got to be careful what you wish for. That brought on unprecedented, almost unprecedented, look back at the 70s, but in our living adult lifetime, significant inflation. And it's taken 3 years to tame it, and it's still not tamed. It's tamed from where it was. But what the Fed is now doing, this whole I'm holding still on the rates and being data dependent, yada, for the last year or so is, hey, we've got 2 mandates. We got to keep people employed, keep you out of a recession, and we've got to keep costs under control. And it's really difficult to do that. And I think we've seen that Fed tools are not really working really well in what we're living through. And so we have risks of both increased unemployment, decreased spending, economic slowdown, and continued inflation pressures that remain to be seen how long they'll last. So I would argue that we have been in a stagflation light economy since probably 2023, with some, times, like you said, the rolling recession. Go back and listen to video number 1, where you've kind of been in and out of the recessionary pressures and in and out of the inflationary pressures. But when you look at it as an aggregate, we've been in several years of a few years of a really stagnating economy. And I think that could very well continue. There are so many factors that go into what gets you out of it, Michael. And that's the question that we need to figure out, and economists are trying to figure out is, how do you get out of stagflation? One or the other. Either the inflationary side gets so much worse and then forget stagflation, you're just in high inflation, or the recessionary side gets so much worse and the recession is actually the cure to the stagflation too. Because once you're in clearly one area of the economy winning out over the other, then the tools become a little bit more effective to try to get you out of that. The reality is stagflation is really hard to get out of, and it's years and years of challenging economic conditions for the American people. So I hope that we get out of this stagflation-like environment quickly. And in my estimation, the recession would be the quickest way to wipe that out, and we could actually get out of it pretty quickly. But high inflation would be even worse, and that could be a possibility. I don't think it is. I was in the camp that we're going to have more and more inflation in prices. I'm not sure that I believe that in the long term, although I think in the short term, we're going to see continued inflationary pressures from tariffs. Long term shows us that it becomes deflationary. rather than inflationary. And once you get consumers that are tapped out, they just won't pay the higher prices. And that's when you get an economic slowdown akin to a recession. But I think we're here. I think I called this one right.
No, I think you did. I think you brought it here first. I think you're absolutely right. I think, economists in general don't like to make calls until, they're very backwards looking, right? They always call it when it's already over.
Right.
I think it would be hard to say we're not in stagflation today. Now, I know stagflation is the boogeyman. It's the thing that the Fed fears the most, but I think it's hard to argue, right? So if you look at just the data, we are growing, but it's kind of, in real terms, we're not really growing, right? If you adjust for inflation, we're not really growing. Inflation, again, is ticking up. We do get 2 inflation readings tomorrow and the next day, PPI and CPI, likely to go up again, at least expected to. And, it would be hard not to say that we're in it right now. But to your point, the Fed's hands are tied, right? The Fed almost has to, in your words, your example, pick which side they want to play on. Right. Because they can either fight inflation or fight a weakening economy. They can't do both given the tools that they have today. And, people ask me all the time, what do you think they're going to do? And in my current opinion, and again, I get this from Jackson Hole, Powell's speech at Jackson Hole. I think he's clearly said that inflation is now priority number 2 and jobs or labor, as he would call it, labor is priority number 1. I think that was a very subtle tweak, but an important tweak at Jackson Hole. So, again, today we got 911,000, reduction, largest negative revision on record, even larger than the 902 it was in 2010 or whatever the last one was. Yeah. And I think the labor market is extremely weak. And, I think this is, I'm in the camp, and I've been in the camp for 6 weeks on it. I'd be curious where you are. I think the Fed should cut 50 next week. I don't, again, given the odds on Fed Watch, it's only a 10% chance, but I think they got to go 50. I think the labor market's getting away from them.
Yeah. When we spoke 2 weeks ago, because we didn't meet last week, it was right before Jackson Hole, and we said, what's the chances that he goes dovish? And although I've been arguing that employment is much, 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 much weaker than they are saying, according to all of the looking under the hood, employment is bad. It's weakening. It's getting worse. They just continued to ignore it and pretend that it wasn't. So I was like, they're not going to shift unless they're really, really worried. And so the fact that they did come out, I thought he would just continue to say, we're going to be data dependent. Yes, it's weakening. Yes, we have concerns, but we're just as worried about tariffs. And he didn't. He came out, and that was a Powell pivot. The other way, a Powell pivot. And he basically said, like, labor is weakening. And he did talk, if you listen to some of the interview questions, he finally was like, we are worried that a lot of the data we know isn't real time. We know survey responses that make us think where employment is are not very good. And we know that the state level data, he didn't quite say this, but Blue Book and Beige Book and some other things that they look at, they understood that there was a difference in the data, and that they finally were saying, yeah, it's starting to weaken more than we're worried about tariffs. And it was the first time I heard Powell, although you've had Waller and some others come out and talk about this. It was the first time I heard Powell say, you know what, I'm admitting that tariffs initially are going to be inflationary. And yes, over the coming months, we could see more inflation, and we've got to worry about that. But he said, over time, we know that tariffs are deflationary, and that eventually in the long term, that lowers the longer term. And in economics, longer term is like a year or longer. It's not what we're thinking like 5 or 10 years down the road. Like these cyclical cycles, these short term, they're like 6 to 12 months usually, and then sometimes up to 18. And then you've got the secular trends, which are longer than 12 or 18 months. And so, he's saying on a secular basis, a year or so out, whatever increase we have in inflation because of tariffs will kind of peter out as consumers start to pull back because of higher unemployment risk. And that risk will come down. And so he admitted, we are now switching from, we're fighting the ugly monster of inflation, and we'll eventually know that it could impact growth and employment in a negative way. He's now saying we're now at that point where it's impacting growth and employment, inflation as a whole, enough that a recession's on the horizon if we don't do something now. So I agree with you because, again, I've been banging this drum since the end of 2023 that employment is recessionary. It's worse than what they're saying in so many different areas of the country. The state employment level data has been pointing to it for the most part over the last 2 years, other than primarily healthcare spending, government spending, and some services like travel and eating out. And so those have kind of been the bellwether that have kind of kept things hanging on, but it made the economy and employment look better than what it really was. So I was glad that he came out and finally admitted it. But here's what history tells us, Michael. At the point that the Fed cuts rates, usually it means we've been in recession, they're late to the game. And once they come out with rate cuts, it's when the markets suddenly go, uh-oh, we really are in a recession. All of these price to earning ratios that are up the wazoo, way over what our economy tells you they should be, like the future, the market depends on the rosy soft landing and no recession, no major inflation, just the next expansion. We're here. And that's what the market's looking for. So history tells us that this happens a lot, that anytime we get to recessionary type conditions and the Fed pivots, the markets panic. They sell off. They are surprised. They finally admit the economy isn't as strong as we think. And it becomes kind of the self-fulfilling prophecy that, the companies finally start to lay off. The profits start to cut. They can't hang on anymore if they can't boost their profits and keep pushing prices, to prop up the stock market. And so what we see historically is the minute the Fed cuts rates, that is what kind of sets off the realization that recession is here, the stock market decline. And then if you look at the leading economic indicators, which I mentioned briefly on our earlier video today, talking about rolling recessions, but these leading economic indicators, 7 out of 10 are now negative. There's 2 that are positive, very slightly the increase in consumer credit, and more largely the stock market continues to do well. There's one other, and I can't remember. Oh, it's manufacturing employment hours. The number of hours worked in manufacturing are just slightly positive. But the LEIs, which is what tells us what is coming, right? It's flashing recession to the Bureau of Economic, the NBER, National Bureau of Economic Research, who dates the recessions. It's flashing for the 4th month in a row. Recession. It's over the last 6 months, they've gotten worse and worse and worse. So we're not in real-time recession. But once those economic indicators tell you the only thing really going well is a little bit more manufacturing hours, the stock market, and credit, when you start to see the Fed cut rates because they're worried about employment, it's like the come to Jesus moment when the markets go, uh-oh, we're in trouble. So what happens, Michael, if they cut 25 basis points, it's kind of priced in, like 90% of the market thinks they're going to cut it. So they might not be too worried if the Fed cuts 25 because they've been waiting for this for so long. And they're like, yeah, we know we could have an uptick in unemployment, and it went up, but it still only went up a little bit. It's like what, 4.3 again, or did it go to 4.6?
No, 4.3.
Okay, 4.3. So the markets have kind of priced in a 25 basis point cut. Hey, the Fed has admitted we're a little too restrictive. And if we don't cut 25 at least, then maybe it's going to make the labor market get worse. But if Powell comes out, as much as I want him to cut 50 bips, because I got loans resetting in October, November, and February, right? I want that big cut. The reality is if he comes out with 50 instead of 25, I would bet a lot of money that the markets flip out. The markets sell off, and that's when everybody realizes. And then you have panic selling, you have layoffs, and then people who are already very nervous about the economy, consumer confidence, and all of that stuff that we talked about, that makes them even more worried. And then they drastically pull back on spending. So it becomes this self-fulfilling prophecy. But history tells us that is what happens. So do I want him to cut 50? Selfishly, yes. Do I want him to cut 50? I think if they did, it'll put us in that recession, and at least we can say we're at the bottom and it's over. Now let's focus on recovery and start expanding. Let's lock in all the real estate we can at those low interest rates and lock them in forever, for 30 years. it would be more exciting to me to see a recession, not because I want people to hurt, because I think we've already been in it, to the point of the rolling sessions, but to say, okay, it's over. Because when that happens, it seems like suddenly, but it's really the end. And so
it's the end.
Then you know what's coming. It's recovery and expansion. And so Powell, if he comes out with 50, I think that's going to happen. And it's good news because it gets us out of stagflation.
Yeah, it's an event.
Otherwise, if he cuts 25 and the markets don't react and they just keep holding on to hopium for that expansion, they're slowly going to see more layoffs. People will slowly pull back at the same time that the tariff increase in inflation spikes up, at least in the short term. That means longer stagflation. And then who knows when it's going to be that we pull out of it. So because of that, I'm going to say, I hope he cuts 50, but he knows what cutting 50 brings, and it will kind of bring us to that point of recession. And he doesn't want that on his record either. So he wants to be the one that didn't cause a recession.
He wants the soft landing.
Too late, Powell, too late on the inflation side, too late on the recession side. So I think he comes out for 25 basis points, even though I think he should cut 50.
Folks, let us know in the comments below. Will it be 0, 25, or 50 at the next Fed meeting? Anna, where can people find you?
You can find me on your channel, social media, Anna Kelly REMA, and for real estate and wealth coaching and consulting, you can book an appointment with me at AnnaKellyInvesting.com.
Thank you so much.